Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. We're tracking a fundamental market transformation currently reshaping the entire technology sector. The AI earnings supercycle is no longer a forecast. It's delivering measurable results right now, and the winners and losers are becoming crystal clear. Nvidia just posted numbers that confirm what sharp traders already knew. Physical AI infrastructure, that's where the money is flowing, and traditional software giants are facing serious multiple compression. Let's start with the kingpin. Nvidia reported Q4 fiscal 2026 results for the quarter ending January 25th, and the numbers are staggering. Quarterly revenue hit $68.1 billion, up 20% sequentially and 73% year over year. Full fiscal year revenue climbed to $215.9 billion, a 65% annual increase. This isn't incremental growth. This is a structural shift in spending. The profitability story is even more striking. GAAP diluted earnings per share reached $1.76 for Q4, double the 89 cents from the prior year. Full year EPS hit $4.90. But here's the critical metric for gauging pricing power. Gross margins reached 75% in Q4 and 71.1% for the full year. According to Nvidia's official financial results, operating cash flow exceeded $102 billion for the year. That's not a projection. That's actual cash generation at a scale we've rarely seen outside of energy supermajors. Nvidia returned $41.1 billion to shareholders through dividends and buybacks, while maintaining $58.5 billion in remaining authorization. The company scheduled a quarterly dividend of 1 cent per share for April 1st, with shareholders recorded as of March 11th. This combination of growth, margins, and cash return is what separates infrastructure plays from speculative positioning. Now here's where it gets interesting for forward positioning. Nvidia's Q1 revenue guidance came in at approximately $78 billion. Analyst consensus was sitting around $72 billion. That's a $6 billion beat on guidance, signaling continued acceleration in a market many thought would start moderating. As reported by the Motley Fool covering Nvidia's earnings, this guidance significantly exceeded Wall Street expectations and demonstrates no signs of demand saturation. But Nvidia's evolution extends beyond GPU sales. The research from leveraged shares on their earnings breakdown reveals compute revenue grew 58% year over year, while networking revenue surged 263% to nearly $11 billion. That networking number is critical because it signals customers are buying complete AI systems, not just individual chips. This is full-stack infrastructure deployment, and it creates stickier revenue streams with higher switching costs. CEO Jensen Huang continues to drive strategy heading into the annual GPU Technology Conference, scheduled for March 2026, being called the world's largest AI conference. Market watchers are positioning ahead of potential product announcements that could extend Nvidia's competitive moat. Now let's talk about the great rotation that's hammering traditional tech. While Nvidia posts record numbers, Microsoft, Alphabet, Apple, and Meta are all experiencing valuation multiple contractions. According to analysis from Penn Mutual Asset Management published in late February, AI has actually become a headwind for traditional tech leaders as markets reassess massive AI spending programs. This isn't a temporary dip. It's a fundamental revaluation of what constitutes valuable technology assets. The market is asking hard questions about Meta's AI spending strategy while simultaneously rewarding companies providing the physical infrastructure. Morningstar's Markets Brief on the 2026 sector rotation characterizes this as AI disrupting the disruptors themselves. The S&P 500 shows headline stability, but internal restructuring is massive. Capital is rotating out of traditional technology stocks and into sectors tied to the real economy. As reported by sources covering the great sector rotation of 2026, energy sector stocks have seen substantial gains, with oil prices rising approximately 12% year to date. Cyclical names like Walmart and Costco are attracting capital with strong earnings visibility and attractive valuations. This rotation reflects a preference shift from multiple expansion stories to fundamental earnings growth. Investors are questioning whether software platforms can justify their AI infrastructure investments with measurable returns, while semiconductor companies are posting the receipts quarter after quarter. Let's drill into the capital expenditure cycle driving this. Hyperscalers including Amazon, Microsoft, Alphabet, and Meta are forecast to invest hundreds of billions of dollars in AI infrastructure throughout 2026. A substantial portion flows directly into Nvidia's ecosystem, though enterprise customer participation is broadening beyond the original tech giants. The beneficiary list extends beyond Nvidia. AMD and Broadcom are positioned with emerging ASIC-based solutions that could capture share as competitive pressures build. Cloud services divisions, Microsoft Azure, Google Cloud, and Amazon Web Services remain critical beneficiaries of the AI buildout with robust enterprise demand driving infrastructure investments. But here's a critical dynamic traders need to watch. Downstream infrastructure plays are heating up. Power infrastructure, cooling systems, and data center real estate companies are seeing increased investor interest as the physical requirements of AI systems become impossible to ignore. This isn't software that scales infinitely at zero marginal cost. This is industrial scale infrastructure with real power, cooling, and space constraints. Now let's connect this to crypto markets because the rotation is visible there too. Bitcoin experienced dramatic volatility, swinging from record highs around $70,000 to lows below $65,000 before rebounding above $70,000. According to research on Bitcoin price history and institutional investment patterns, these fluctuations coincide with measurable institutional capital migration from cryptocurrencies toward high-growth semiconductor and AI infrastructure sectors. The pattern is clear. As institutional investors recalibrate amid the AI boom, capital is reallocating from speculative digital assets toward established technology companies with fundamental earnings growth. This isn't retail panic selling. This is institutional reallocation toward companies like Nvidia and their downstream beneficiaries. The research from Brown Brothers Harriman on Q1 2026 market dynamics and T. Rowe Price's asset allocation viewpoints highlight that fundamental earnings growth in AI companies is increasingly favored over multiple expansion, especially as valuations face scrutiny following robust earnings reports. So what's the trading thesis here? We're witnessing a structural revaluation of technology assets. Physical infrastructure providers command premium valuations and investor attention. Traditional software and platform companies face skepticism about AI spending returns until they demonstrate monetization. This isn't a typical sector rotation. This is a hierarchy shift in what constitutes valuable tech assets in an AI-driven economy. The key metrics to track: Nvidia's 73% year-over-year Q4 revenue growth, 75% Q4 gross margins demonstrating pricing power, Q1 guidance of $78 billion versus $72 billion consensus, 263% networking revenue growth signaling systems sales, and operating cash flow exceeding $102 billion annually. As of today in March 2026, the AI earnings supercycle appears to be in early stages rather than approaching maturity. The combination of enterprise adoption, hyperscaler investment, and technological advancement suggests continued momentum for infrastructure providers while traditional tech adapts strategies. According to CNBC's reporting on Nvidia earnings colliding with Wall Street skepticism, this cycle is fundamentally different from previous technology booms due to its focus on physical infrastructure rather than purely digital solutions. This creates more durable competitive advantages for companies like Nvidia while challenging growth assumptions of traditional software-focused technology giants. The takeaway for positioning: favor companies with measurable AI infrastructure revenue over those with AI spending commitments. Watch for multiple compression in software names that can't demonstrate AI monetization. Monitor enterprise adoption rates beyond hyperscalers, as that's the next growth driver. And track power and cooling infrastructure plays as downstream beneficiaries of the buildout. This supercycle is reshaping sector allocations, creating new winners, and challenging established leaders to justify investments with measurable returns. The sustainability through 2026 depends on continued enterprise adoption and infrastructure providers maintaining technological advantages in an increasingly competitive landscape. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.